Let's get to the stock of the day, and I thought we'd take a look today at Baby Bunting. So it failed to provide full year earnings guidance, again blaming the uncertainty caused by COVID on the retail space. Profits increasing some 16%, all stores remaining open, which is surprising, paying out a 6.6% per share dividend. Online sales did the heavy lifting, up nearly a third during the 6 months to December. Shares, though, coming under pressure in morning trade. So let's get the view on Baby Bunting with Jun Bei Liu from Tribeca to start. Jun Bei, look, positives are sales momentum, margins increased, also those online sales hitting 24% of sales. What were the negatives? I mean, why is the market not liking this one, do you think, and do you?
Yeah, look, the main reason in market is a bit negative is that they didn't really provide a guidance, so that is creating a bit of issue, and also at the same time they're building a lot of inventory. The inventory is growing really fast. Post the Christmas promotional period. So I think the days of inventory has climbed to 116 days. So that's what it is. But overall, the result was pretty solid. Was pretty good. There was good growth. Talking to good growth, but obviously with the outlook, the company is sort of saying uncertain. And the reason it's uncertain for this company is because it's been a huge beneficiary of COVID, and its the sales, what it might look like going forward in the next 6 to 12 months might be a little bit uncertain.
Also,
but my view is that this company.
Go ahead. Sorry, Jun Bei.
Oh, I was just thinking this company is actually a fantastic business. Whenever it gets sold off, really should take that advantage, take the sell-off advantage to buy this business. Because store rollout is still a lot to go, and 50% of its store still less than 5 years old, which means its margin will continue to expand. And once we're through this cycle, this company will make significantly more money than what it was. So it's a great company. You should be really buying on the week.
Well, that's a buy coming from Jun Bei. Do you see it any different, Mark? I mean, it is in retail. It's in specialized retail. We're going to keep having babies.
Well, yeah, particularly if there's lockdowns, I suppose. So, look, I've got 4 daughters. I'm pretty familiar with this store. I think I've probably bought about 6 prams over the years. So they tend to, there's always something new or more convenient. Look, not providing the guidance obviously hits them a little bit. I don't, NASDAQ negativity and the bond yields being higher probably didn't help realistically overall. But in looking through the numbers, it seemed to me like they were fairly solid numbers. One thing that no one else has said is that they've got no supply chain issues, whereas everyone else has sort of flagged that. So their costs were up a little bit. I think they missed a little bit on expectations on EBITDA. Look, and they are a slightly higher PE, but as Jun Bei said, like they've got some stores in early stage, so that's perhaps justified. Look, they pay a dividend. Perhaps we probably wait till the smoke clears a little bit with these, with these benchmark yields going through, pretty significant highs at the moment. I think there could be some overall weakness. I probably wouldn't be buying necessarily today, although I don't know why on the back of those results the stock's really down, to be honest. They look fairly positive to me, but I think you may get them slightly cheaper just on the broader market pulling back a little bit, but I agree with Jun Bei. I'd be buying the dips on this one. So.
But not today, so it's not going in the portfolio. Them's the rules, folks.